Welcome to the IFTA interview, this time with our previous guest speaker, Jean-François Owczarczak, speaking about what he presented before, the power of cross-asset confirmation. Please, can you share why this was important for you to present at the 2020 conference?
Hi, Ron. Well, I'm delighted to have this interview today. I was delighted to present at the conference. I hope many of you attended. There were many of great speakers. And yes, my theme at the time was the power of cross-asset confirmation, because I do use a lot of cross-asset confirmations in order to get as much robustness as possible in my forecasting. Why so is that if you look at just one single instrument in isolation, well, you might be right, you might be wrong, but it's a very binary process. And I think that by looking at many assets in coordination and trying to understand how the different trends fit together in some kind of a macro outlook, does bring a lot of does bring some kind of a scoring system, which does increase the odds in the forecasting methodology.
And this is quite important, of course, because many professionals in the technical analysis space and in any other an analytical discipline can look at one side of the trade or get married up to a particular market. Mm-hmm. So it's a great point you make about having a scorecard system, but also one that can self-confirm key signals or maybe show the divergences that might exist. One additional point, which I thought would be great to share based upon your unique methodology, mm-hmm. is in your opinion, what gives it an edge? I mean, I know that there's a cycle element to what you do, but in your opinion,
I think that cycle element is very important because it allows us to basically do a forecast timing. So to anticipate when a specific event is likely to happen in the market. So for example, if you're in an uptrend, when do we expect the next intermediate top? Or do we expect the next intermediate top to be a very important top? Or if we're in an uptrend and we have been correcting over the last few weeks, when can we expect to have a good buy the dips opportunity to be able to re-enter that trend and profit from the next leg up? And our methodology with this timing forecasting element to it is well adapted to do that. And once you have your forecast on various assets, well, then it's important to try to make sense if all these timing points do coordinate in the future. And so again, we think our methodology of forecasting is very well adapted for this cross-asset analysis.
It would be great to have maybe an educational visual framework if you have one at hand, just for the audience to see.
I will go to it. I'm going to try to keep it quite short, and you need to activate my screen share. So it's only going to take you a second.
Yep, there we go.
And then I could go to my screen and maybe a bit on the theory, and that's taken from the presentation I actually held at IFTA. As said, I'm going to be quite quick on it. If someone needs to go deeper into detail on our blog, so you could see here is our website, mjtsa.com. You have the full presentation that we held at IFTA, which you could go through. And it has a section on education, which is about 20 pages. And so you will be able to get more insight. But basically, our methodology uses three types of instruments. One to monitor the trend. So we use standard deviation envelopes, so envelopes around a mean. We have a larger envelope, which is the dark yellow envelope, for which we use to identify the longer direction of the trend. And then a shorter term time frame envelope, which is a swing factor in that trend. So when you have the small envelope that comes and hits against the larger one, it does mean that the short-term trend has gotten ahead of the longer-term one. and that you can expect either some kind of a retracement or a reversal of the trend. And so you see here, for example, how our envelopes actually reacted. And this was the S&P 500, a very long-term chart between 2005 and 2010, for example. Then moving quite quickly, the second element of our methodology is price targets. And to be able to calculate them, we use the width of the larger envelope here. And this gives us a measure of amplitude, of historical amplitude, and of historical volatility. And it's quite nice to have because it's standardized. We're not looking at the previous move and wanting to do a retracement or a projection on it. It's simply an automated calculation of what was the volatility over the length over the length of the chart. And we then use it similarly to retracement and projections by factoring this volatility measure up by either a corrective factor, which is 0.5 to 0.8 times the volatility, or an impulsive factor, which is 1.3 times to 1.7 times the volatility. And then we would add this result or this product for example, in an uptrend, to the lowest point of the chart. So, so the first element is to understand where the trend is going. The second element is to understand how much potential we actually have in that trend. And then finally, we go on to the timing element, which is basically based off oscillators. And we use a system of 3 oscillators: a long-term black oscillator, which is going to be quite slow and go from the oversold to the overbought zone. You probably have 1 or 2 impact points on a chart. Then you have a medium-term oscillator, which is the red one, which is twice as short, and which is basically going to help us identify intermediate tops. And then we have a shorter-term oscillator, the blue, which is even more short-term. The idea is that when you're looking at an oversold condition, it does take time to get the confirmation that the trend has actually turned. And by that time, the price may have moved quite a bit, which means that you will be in a risk-reward situation, which is perhaps a bit uncomfortable. Now, if we use 3 oscillators and try to find a harmonic low on those 3 oscillators, you're in a situation where not only do you know you're quite oversold, maybe on the long term and the medium term, but you have an inflection point on the short term on which you could start to react more quickly than if you were relying only on the long-term oscillator. And similarly, if you look at a top, if you have a coordination of 3 tops, long-term, a medium-term, and a short-term top, which happen at the same time, you have a lot of harmonics that something is happening and that things are ready to turn, but you could also start to react on your short-term exaggeration and on your reversal of trend of our short-term blue oscillator. And then the other element of the methodology is that by using 3 oscillators of different degrees, you could monitor different legs up. So your first leg up is the short-term leg up with the blue oscillator, and it actually is probably going to have a top and then some retracement. And then if the medium-term oscillator manages to catch up with it and gain momentum and make it above where the previous blue was, that's a sign of strength in the trend and of a developing uptrend. And then once the black oscillator does come and with its own momentum makes it above the previous red and blue, that confirms your upside the momentum. And henceforth, that means as long as you have higher tops of an ascending degree, you're in an uptrend. And similarly, if you correct down into a low point, and you can't really manage to create that downside momentum to have a lower red bottom here, it means that you are actually resuming the uptrend. And here also, as long as you have bottoms of higher degree which are ascending, you're in an uptrend. So that allows you to monitor the uptrend as it goes. And then these models are not chosen randomly, and there's a timing relationship between the oscillators, so that when I see a blue-red sequence, I could project in twice the distance when I expect the next intermediate top to be. And similarly here, when I have this blue, red, black top succession, I could then project when I'm likely to see the next important top to happen. And that's the forecasting methodology we actually use. Just quickly, oscillators do seem a bit complicated. It's not a crystal ball, it's simply a GPS. So we have an uptrend model, which is our ideal uptrend model on our oscillators, and an ideal downtrend model. And when we look at our oscillators configuration, we try to match a position of these oscillators to one of these uptrending or downtrending model. And for example, if you reach an intermediate black top here, well, the model will tell you that you should be correcting for a certain period of time, which is X and depends on the frequencies. And then you should be stabilizing probably for another period of X. And then you could, for example, reaccelerate towards a new high, which will happen in 1 or 2 units of time. So when you are on an intermediate top, similarly, you would project the next top pretty much in 3 to 4 units of time. And that's how we do our projections and can anticipate the timing of inflection points in a trend. I know it was a bit long, but that's what I could say very quickly about our methodology.
It's great to get a good overview and a comprehensive one at that. I mean, there are different moving parts, and of course, that's what keeps the system robust. If I can follow up on the next question, of course, having read the latest preview of your monthly report, the lead was the whole bond yield story, and I'm really kind of keen to dive in terms of what you are thinking on the move. It's been in absolute terms, it's been a small move, but a lot of people talking about rate of change and whether this might be the canary in the coal mine. So are you concerned by the rise in yields?
Well, concern is probably not the word. I think yields will really be of concern when real yields start to move up. At the moment, most of this move is plagued by the huge injection of liquidity that we've had, and is mostly translated into higher inflation expectations. But real yields for now have really failed to react. And so it might come later on in the year or over the next few years, but for now, I think it's been mostly driven by liquidity for now. And maybe quickly, I would like to show the long-term chart of. Sorry about that. Can you see my screen, or did I do something wrong here?
And not at the moment.
Okay, well, let me just fix that. Okay, well, Ron, I'm afraid I lost you. Oh, here we go. There we go. It happens. And so if we're back, I wanted to show the long-term graph of the US 10-year. And it's certainly oversold. I mean, you can see the move. This is a 10-year chart. You can see the move over the last a couple of years, and our oscillator series on both our medium term, which is a bit more stochastic, and on our longer term, which is a bit more momentum, are oversold, and certainly the downside of potential over the next few years is probably quite low. Yet, if I do use my models to put in a projection from the down move, which was started in the fourth quarter in 2018, the bottom that we did last year comes a bit early. And so our view is that we've had a very nice rally since August. That this rally is probably coming towards the end of the first leg up, and that we could see some kind of retracement. I'm not thinking about a full retest because we're very oversold, but some kind of retracement on yields, which could start to materialize probably from mid Q1. and could last 2 to 3 months into mid, perhaps late Q2. And then I would expect yields to probably attempt a second leg up. And the big question we'll have at the time is if that second leg up will be a liquidity-driven leg up again, or if it will mostly be influenced by a strong recovery in the economy. And in that case, it might be more damaging for equities because it will have an influence on real rates. Sorry.
And liquidities, as many people have been following, been a big story since late last year in terms of the massive acceleration, not just of central bank liquidity, but also of retail institutional speculative liquidity. What's your read on that trend? Will it continue to overshoot on the charts, or is there likely?
Well, it's a strong trend, and I think it's probably the story of don't fight the tape, don't fight the Fed, and for now, at least this first leg up, as we could call it, in our view, is still underway. And maybe we could have a look at the All Country World Index, and our view on equities is that the period that we saw between 2018 and 2020 was a widening triangle, but we do believe that this widening triangle is finished. It did see an ABCDE structure. It did see a climax sell-off, which was impressive, and since then has been recuperated very rapidly, made it above the middle of the triangle, even made it up to new highs, and is now continuing higher. So I think we're in something quite big here in terms of new secular uptrend. It might be considered nominal and artificial, but it is underway, and I think it should continue. And from what we could project for now, at least into the beginning of 2022. If we look at, if we do put a model here, we think we have a new uptrend that actually started in the month of March with the lows of the market, and probably extends in first instance into the end of the first quarter. Then we do expect some consolidation, and when we do our models, if we are in a strong uptrend, we are always too conservative on the long-term oscillators because we would expect 6 months of consolidation here. But what we would likely think could happen is that we do get 3 months of a market which turns more defensive in a retracement trade, then some stabilization during the summer, and then probably a new acceleration up towards the end of the year. And so yes, this is a strong market with a strong trend. We might see a bit of retracement, which will be healthy during the second quarter, but we don't believe that this uptrend is finished yet, and that it could continue probably towards the end of this year, perhaps early next year in first instance.
So strong long-term trend, risk of a short-term pullback, not a big cliff drop. And just to add the macro overlay point that I picked up again from the same preview report for this month, this idea of a strong, weak paradox between a potential surprise, pleasant surprise of a bounce back in the economy, potentially being a little bit of a downside pressure point for the market. Are you seeing that in your charts? How does it work?
I think it can happen. It can happen. It's probably not for this leg up. I think we're still in this liquidity rally. It's going to see some retracement, maybe towards the second half of the year. But what I would really need to see for that is that, again, I would need to see real rates starting to move higher. And for now, if you look at the long-term graph of TIPS, well, the uptrend still seems underway. So I'm looking at the TIP iShare TIPS bond ETF. And if I do put a model on that, well, for now, it still seems to be uptrending towards the end of this year. So, I mean, we might see a bit of that at some point later on in the year, but it's not something that I'm seeing as an imminent risk for the time being. That also leads me to think that the retracement we're going to have in the second quarter of this year might not be that directional, might be more consolidation, might be more rotational. As said, we believe that interest rates and long-term years especially should see some retracement into the spring. And so we're wondering if we're not going to see some kind of a rotation back into the growth themes, which have been underperforming cyclicals since early September. And to show that, I wanted to put forward the chart of the Nasdaq, and instead of comparing it to the S&P or to the Russell, for example, I thought it was interesting to compare it to staples, because if you do have a strong correction, and you could see it here in 2018, you could see it here in the summer of 2019, you could see it here in 2020, that correction should be strong enough to be able to dent the uptrend in the Nasdaq versus the staples ratio. And it doesn't seem to be the case at the moment. According to our models, well, we've had a bit of high-level consolidation here as yields have bounced, and we are resuming the uptrend at the moment, and we might have a bit of more of a dip short term, but in essence, that trend on this ratio seems to continue into the summer, and the machine is telling us that it could continue into August. We don't expect it to be stellar because the trend is still already very well or very much advanced after 10 years of uptrend, and our targets are pretty much reached. But we do think that growth stocks are probably going to make a comeback, and while cyclicals could correct during the second quarter, growth could hold the market. And that reminds me quite a bit of what happened in 2017 following Trump's election, and also quite a strong euphoria rally following it, and interest rates that actually also moved up quite aggressively and into the first quarter. And then starting mid the first quarter, all that cyclical trade kind of died out. And it took about, well, it took 3 months a retracement and then another 3 months of stabilization before it actually started to move up again towards 2018 and then 2019. And I'm wondering if we're not going to have the same type of cyclical retracement while the market in general pretty much holds up thanks to rotation.
And of course, a lot of this can be supported by the new presidential outcome of Biden and his $1 trillion liquidity kind of support in the market. And I'm just thinking, looking across the seas, I noticed on your model radar, emerging market is also outperforming the world. Tell us a little bit about how you see emerging markets and what might be driving that in Asia.
Well, I think emerging markets is very interesting because it's a great mix at the moment. You have the dollar, which is coming down. And I'll quickly show a chart on the dollar just afterwards. You have the dollar, which is coming down, and you have commodities, which are moving up. And a whole part of the emerging markets index is very linked to these commodities and is helping them outperform at the moment. And it will probably continue to do so for another month or so. And then thereafter, China, which has been more on the retracement mode over the last few months, and probably accompanied by other Southeast Asia, East Asia countries such as South Korea or Taiwan, will probably relay up and be able to help emerging markets continue to outperform, as they are more counter-cyclical in a way, especially Taiwan and China. And so as the market goes into more of a growth theme or retrace a bit into the second quarter, they may be the strong outperformers. And so because of this mix, I think the outperformance of emerging market is going to be quite stable throughout the year. A few more weeks, maybe month or so on the cyclical side, and then with a strong relay from China and Taiwan. And I just wanted to show the chart of China, of the MSCI China versus the All Country World Index. And what I thought was interesting here is that, yes, indeed, it is counter-cyclical. When markets fall, China basically moves up on a relative basis. And we had a bit of a cyclical correction here in June. China was also very strong. And here also in October, China was also very strong. But what we could say about this ratio is that basically the retracements are smaller than the actual impulses. And so I think we're in a secular uptrend here beyond that counter-cyclical element. And from what we could see on our models, there's probably another few weeks of retracement, which is possible. It has already started to bounce. It may come back a bit on a relative basis. But then until the fall, and the machine is telling me October here, it seems like China is going to be very strong versus the rest of the world. And we're currently on this ratio at 1.2, which has 100 basis here at the beginning of the chart. And we believe that we could make it up to between 117 and 128. So that's between 15 and 20% outperformance. And China is about 40% of the emerging markets index. And at Taiwan, that's another 15%. So that's going to be a strong influence and a positive factor for emerging markets.
And how much of a tailwind can the dollar have? Because I know you have a view on the dollar, maybe a two-part, short-term and long.
Well, I mean, the big question I'm hearing in the market is that I'm wondering if this is a big ABC correction on a needle wave basis, and that we're ready to find some kind of support here, and the dollar could accelerate up on a secular basis. Well, if you look at our envelopes, they have started to turn down and could be eyeing some kind of a rounding top here. And our machine here is seeing a high-risk configuration. And a high-risk configuration is basically, and I have to make it slightly smaller because it's not perfect in this case, but it means that you've had a kind of a saucer correction, and then you've accelerated up again. And we didn't necessarily make new highs here, so that is perhaps a sign of weakness. And then when we look at our shorter term graphs, well, it seems like it's still a developing trend. And I think there's another maybe couple of months, and the model is also a bit smaller here. I have about a 10% leeway, which I can apply to my models. But I mean, it's also here, I mean, the downtrend doesn't seem quite over. So, I mean, it's well extended. We think it's probably has another month and a half to go. It has done maybe 80% of its move, but it still could continue a bit. And by then, it may come and hit against support here and maybe break below support against them the next month or so. In Asia, the Taiwanese dollar is already well above a resistance versus the dollar, or the dollar is well below support versus the Taiwanese dollar. The Chinese yuan is also on the verge of breaking up versus the dollar. So I think we're going to have some kind of a dollar reaction from the end of the first quarter into the second quarter, but I do think that it's probably going to be an intermediate bounce. It might be strong, but we see it lasting maybe 3 to 4 months, and then we probably expect further dollar weakness behind that towards the end of the year.
And to kind of ground us into the kind of the safe haven trade territory, there's this kind of big question now on not just one, but but two, gold and digital gold, Bitcoin. I mean, what can you say about both of these markets, but particularly in terms of what some people are asking about the substitution effect? Does it exist? And what is the potential for either market?
Well, basically, you're comparing monetary systems. You have a monetary system which is fiat and which is, in a way, is in a self-fulfilling acceleration, which I have trouble seeing it stopping before we end up at some point in a crisis. Might be in a few years, but at some point you're going to have the S-curve of loss of confidence, which is basically going to have to end up in some sort of a restructuring of that monetary system. Then you have gold, which is the long-term traditional preservation mean of value, and which I believe at the moment is very much reacting to what's happening with interest rates, meaning that if interest rates do take a turn to the upside, and if that turn is mostly then plagued by an economic recovery and a rise in real interest rates, you might see an important top on gold. But at the moment, as said, I think we're mostly in a counter trend. That counter trend is almost finished. The move up in interest rates was mostly influenced by inflation expectations. And so I would expect that as nominal rates top out, probably over the next month or so, gold should make a support bottom and start accelerating higher, probably into the spring. And maybe we could look at the weekly chart here, which
in terms
show
of
that.
Are you seeing 2000 or even above 2000?
Well, I mean, as you see here, there's a bit more leeway for correction over the next month or so. The target range is somewhere between 1830 and 1700. 1800 has held very, very well recently. I still think it will hold, but we might make it a bit slightly below it. But then we do expect a support point here and a first acceleration up. The machine is telling us April as a possible target. I think we will see new highs by then, and then we might see a bit more of a new period of retracement into the summer. But eventually, this uptrend is still on the way and probably continues further on into late, well, from late summer into late this year. And that probably means further debasement in the dollar. But in general, if we follow this model up, there's still quite a bit of time left, uptrending time. And so if I calculate my impulsive 2 targets, which we do every once in a while, maybe in 10% of times, we've reached our impulsive targets given the strong move since 2018. Well, at the moment, if I do calculate these, they lead me somewhere between 2,200 and 2,400. So my view is that by April, we should make new highs, and by the end of the year, we should make it up to 2,200, 2,400 on gold. Switching to Bitcoin, it's true that it's an alternative monetary system. It's true that the loss of confidence in fiat currency is certainly fueling a very strong a secular argument that cryptos could take much more of importance as a one conservative value, but I think most and for all as a transactional mean. I think the most important element on Bitcoin recently was its introduction on the PayPal platform, and so I mostly see it. And so I do believe that it's mostly this argument which is fueling its acceleration, is that it is gaining traction among institutional, well, among commercial players, and hence attracting some institutional investors. And for me, it is very much a momentum trade at the moment, and I think liquidity has helped a lot too. And if you want to look at another chart that looks a lot like Bitcoin, is that look at alternative energy at the moment, and it's exactly the same kind of acceleration. And I think that probably has another month or so to go. And it's hard to make projections with such aggressive beasts as alternative energy at the moment, or Bitcoin. But that by the end of the quarter, with markets that maybe start to retrace, we should probably make a top on them. So I think the retracement we're seeing at the moment over the last few days is probably intermediate, that we will make new highs over the next month or so, probably making it up to 45, maybe 50,000 on Bitcoin. And then during the spring, we might see more of a retracement. And I'm thinking, as these are very volatile instruments, maybe something like 40, 50% retracement on Bitcoin. And then if we do have another liquidity break rally towards the second half of the year, there's no reason why Bitcoin cannot accelerate again and make new highs. Because the problems we have at the moment by fueling this endless provision of liquidity to try to get our economy back into shape can only be positive arguments for the asset class.
So a two-part potential move, down up to 50%, but then new record highs for Bitcoin maybe in the second half due to the crisis hedge or the liquidity play.
Well, I think we're going to have a first new high before this move is ended over the next couple of months. And then we're going to have some retracement, and then perhaps more strength towards the second half of the year, yes.
Great. Thank you so much for the kind of market outlook for 2021, where a lot of people will be looking at the year ahead to kind of bounce back from the roller coaster ride of the past year, although it was, I think, mostly profitable for many. Question, non-chart related and more to do with IFTA, so we'll maybe switch
back.
To conversation mode, and just an open final wrap question on your membership and activity with IFTA, the International Federation of Technical Analysis. So you were a speaker at the 2020 conference, but before that, you've been a big supporter of both IFTA and the Swiss Society, where we both work together locally. And then the last thing I wanted to say, of course, as part of the professional development, you're also a winner of the Bronwood Prize. What can you say about IFTA, SAMT, and the whole professional development of our discipline?
Well, I think many technical analysts start with technical analysts because they need it. So they're trading, they're investing, they're wondering where the trends are going, and so a lot of technical analysts start by learning by themselves. And the problem with that is that at some point you get too focused on a methodology, and there's a lot of other work which has been done out there over the years, which is very, very useful. And myself, I started in 2003 as an institutional consultant, and I only passed my exam in 2012. So I had time to perfect and work through our own methodology. And it was very enlightening to me to pass the exams at the time. Discovering a lot of new angles, which many of them I use today as complements to our own methodology. And one of the things I've developed a lot at our company is the cross-asset aspect. And I think thinking about John Murphy or Martin Pring, they have been huge influences on the way I look at the market. So I think it really broadens your scope and brings a lot of complementarity to what you could be doing. So very positive. And then on IFTA itself, I think it's great to communicate and argue with different technical analysis. We all have our angles, we all have our methodologies, and it's great to have argumentations about the market. And I think having argumentations about the market just allows us to basically test-proof our own argumentation and to see where are the strong points and where are the weak points, which basically help us understand where we might be weak in our scenario going forward in the markets and where we need to do more work or try to understand it maybe from another angle.
So in terms of certainly strengthening the discipline, but also maybe developing this muscle for scenario planning and probabilities, nothing is set in stone. One of the unique backstory heritage that you have, Jean-François, is this multi-generational focus in markets. Can you share a little bit of that and maybe how has that inspired you in the work that you do?
Yeah, I don't want to make too much fuss about it, but we all have. It happens that my grandfather was already using technical analysis a lot, and my father made his whole career on it. I think each one of us have gone through the whole schooling and the whole self-development process. My grandfather was the head of a small stockbroker house in Santa Fe, New Mexico, in the U.S. And to be able to advise his clients, he was using a lot of technical analysis. When was one of the early Elliott wave adopters, and did do quite a lot of research on volume and the relationship of volume and prices. My father, when he set up his own consultancy in Geneva, Switzerland, in Europe, there was not that much volume data available. So that's why he went into using cycles and oscillators to be able to complement his analysis of price. And I think my bit of a contribution over the last 15 years is really this cross-asset angle, which I've tried to really strengthen within our methodology.
Thank you so much for a wonderfully rich and broad discussion. Where can IFTA members go to for more information about your work?
Well, I try to update my blog as often as I can. And so you could go to our website, which is mjtsa.com. And you will see it on one of the charts, or you could read it off the charts I've showed on this presentation. And thank you very much all for your attention and for your time.
Thank you very much. We look forward to meeting again.
Yeah, great run.